All right, folks, let's talk business. Let's move beyond the spark of the idea and into the architecture of your enterprise. You've got that brilliant concept, the one that keeps you up at night with excitement. You've poured in the sweat equity, worked the late nights, and you're finally seeing the fruits of your labor. The first sale, the first client, the first positive review, it's all starting to happen. That's fantastic. Seriously, take a moment to appreciate that. You've done what millions only dream of. You've turned an idea into a reality. But now comes the part that makes a lot of people nervous. The official stuff. The paperwork, the legal jargon, the decisions that feel heavy and permanent. I'm talking about setting up your business the right way by choosing a legal structure. Think of it like building a house. Your idea is the design, your hard work is the labor, but the business structure, that's the foundation. A weak foundation can't support a skyscraper, and the wrong business structure can limit your growth, or worse, cause the whole thing to crumble. Choosing a business structure isn't just about filling out a form and getting a fancy piece of paper to hang on the wall. It's one of the most critical strategic decisions you'll make. This single decision will profoundly affect how you pay taxes, how you protect your personal assets from business debts and lawsuits, your ability to raise money, and yes, how much paperwork you'll be drowning in for years to come. So let's demystify it. We're going to break down the most common structures so you can choose the right foundation for the empire you're building. First up, the default setting for many new entrepreneurs, the sole proprietorship. This is the simplest structure imaginable. In the eyes of the law, you and your business are one and the same. There's no legal separation. If you start doing business and don't register as anything else, you're automatically a sole proprietor. The pros? It's incredibly easy and inexpensive to get started. There are no formation documents to file with the state to create the entity itself. You have complete control over all decisions and profits, and taxes are straightforward. You simply report your business income and losses on your personal tax return using a form called a Schedule C. But the major, and I mean major, drawback is unlimited personal liability. Since there's no legal distinction between you and the business, you are personally on the hook for all of its debts and legal obligations. If your business gets sued, the plaintiff can go after your personal assets, your car, your savings account, even your house. This is the critical risk you must understand. It's also harder to raise capital, as banks and investors are often hesitant to fund a business that isn't a formal legal entity. So, who is a sole proprietorship for? It's best suited for low-risk businesses, freelancers, or entrepreneurs who are just testing a business idea and want to keep things simple and cheap at the very beginning. Now, what if you're not going it alone? That brings us to the partnership. A partnership is essentially a sole proprietorship for two or more people. Like a sole proprietorship, it's relatively easy to form. The profits and losses are passed through to the partners to report on their personal tax returns. But this structure carries the same huge risk: unlimited personal liability. In a general partnership, not only are you liable for your own actions and the business's debts, but you're also liable for the actions of your partner. If your partner makes a disastrous business decision, you could both lose your personal assets. This is why, if you even consider a partnership, a comprehensive ironclad partnership agreement is not just a good idea. It's absolutely essential. This document should outline responsibilities, contribution levels, how profits and losses are split, and what happens if someone wants to leave. This brings us to the most popular choice for new small businesses in America, the Limited Liability Company, or LLC. The name says it all. The number one reason to form an LLC is to get that limited liability. An LLC is a separate legal entity from its owners, who are called members. This separation creates what's known as a corporate veil. This veil protects your personal assets. If the business incurs debt or is sued, creditors and plaintiffs can generally only go after the assets of the LLC itself, not your personal bank account or your home. This protection is the single biggest step up from a sole proprietorship or partnership. Beyond liability protection, the LLC's other superpower is its flexibility, especially with taxes. By default, a single-member LLC is taxed just like a sole proprietorship, pass-through taxation. A multi-member LLC is taxed like a partnership, also pass-through. But an LLC can also elect to be taxed as an S-corporation or even a C-corporation, which can offer significant tax advantages as your business grows. This flexibility is huge. It allows your business structure to evolve with your business's needs without having to dissolve and reform the company. It also adds a layer of credibility and professionalism to your operation. The downsides? It costs money to file the formation documents with the state, typically a few $100s, and most states require an annual report and fee. It's more complex than a sole proprietorship, but for most entrepreneurs, the liability protection is well worth the minor increase in cost and administration. Finally, let's talk about the heavyweights. Corporations. There are two main types we'll discuss: the S-Corporation and the C-Corporation. A corporation is the most formal business structure and is a completely separate legal entity from its owners, who are called shareholders. It offers the highest level of liability protection. Let's start with the S-Corp. An S-Corp isn't actually a business structure you form, it's a tax election you make with the IRS after forming an LLC or a C-Corp. It combines the liability protection of a corporation with pass-through taxation, similar to an LLC. The key advantage here is how it can potentially save you money on self-employment taxes. As an owner who works in the business, you must pay yourself a reasonable salary, on which you pay regular payroll taxes. Any additional profit can be taken as a distribution, which is not subject to self-employment taxes. For profitable businesses, this can lead to thousands in tax savings each year. The catch? The IRS has strict rules. There are limits on the number of shareholders, 100, and shareholders must be U.S. citizens or residents. S-Corp also have more formal operating requirements like adopting bylaws, holding board and shareholder meetings, and keeping detailed records. And that brings us to the C-Corporation. This is the structure of most large, publicly traded companies. Like an S-Corp, it provides robust liability protection, but its defining feature is how it's taxed. A C-Corp is taxed on its own profits at the corporate tax rate. If it then distributes those profits to shareholders as dividends, the shareholders are taxed again on their personal returns. This is known as double taxation. So why would anyone choose a structure with double taxation? Three main reasons. First, C-Corp are the most attractive structure for outside investors, especially venture capitalists. They can issue different classes of stock, which is essential for fundraising. Second, there are no restrictions on the number or type of shareholders. And third, C-Corp can reinvest profits back into the company at the corporate tax rate, which may be lower than the owner's personal tax rates. It's the go-to structure for startups that plan to scale rapidly and seek venture capital. So, how do you choose? It boils down to four key questions. 1. What is your personal liability tolerance? If the thought of losing your house over a business lawsuit terrifies you, you need to move beyond a sole proprietorship. 2. What is the most advantageous tax situation for you now and in the near future? 3. How complex do you want your business to be? Are you willing to handle the administrative requirements of a corporation? And 4. What are your future needs? Do you plan to seek investment, bring on partners, or sell the company one day? Before we wrap up, let's cover a critical mistake many entrepreneurs make: piercing the corporate veil. Even if you have an LLC or a corporation, you can lose your liability protection if you don't treat the business as a separate entity. This means you must not commingle funds. Get a separate business bank account and use it for all business transactions. Don't pay your personal mortgage from your business account. Follow the required formalities, like holding annual meetings. If you treat the business like your personal piggy bank, a court might too, and your personal assets will be back at risk. The bottom line is this: choosing your business structure is a foundational act of strategy. It's about protecting what you've built and paving the way for future growth. While you can change your structure later, it can be a complex and costly process. It's far better to make an informed decision from the start. Take your time, assess your specific situation, and don't be afraid to invest in professional advice from a qualified attorney or CPA. That initial investment can save you a fortune in taxes and protect you from devastating liability down the road. This isn't just paperwork, it's your armor, it's your blueprint, it's the first step in building a business that lasts.